Hello everyone, I'm Astha Khurana and welcome to Zerodha Varsity videos. This is episode 3 of Crash Course on Warren Buffett's letters to his shareholders. In the previous episode, that was episode 2, we talked about merger and acquisitions, we talked about reported and unreported earnings, and we also talked about one of his famous businesses, that was Nebraska Furniture. In this episode, we are going to cover his letters from the year 1987 to 1991. And for that, I have Vineet and Satya from Team Varsity. So let's begin. So Vineet, we have reached to episode 3 and let us help us understand what did the economic period look like now and what is the agenda for this video.
All right. So around this time, that is 1987 to 1991, the market was very richly priced. Warren is saying that this was not a very good time to invest in equities because most of the stocks were priced over their fair value. Along with that, he's also mentioning 3 of his forever investments. So, of course, he's invested in a lot of companies, a lot of listed companies. Among those, he's listing 3 companies that he does not want to sell.
Okay.
Then we talk about insurance because insurance is the biggest business for Berkshire Hathaway. This is also the time when a lot of accounting scams are unfolding. So, Warren Buffett is also taking a jab at the auditors.
Okay.
Warren Buffett also takes some time to criticize investment banks while also having invested in an investment bank himself. Apart from that, he's also invested in a few other businesses around this time, being Gillette, Coca-Cola, and a few shoe businesses. And lastly, in 1990, Warren Buffett has completed 25 years of running Berkshire Hathaway. So we will reminisce about the last 25 years as well.
You see, my eyes lit up when you were talking about some of his investments when you mentioned Gillette and Coca-Cola. And in the previous 2 episodes, we have discussed about his investments like quite in the latter half of the video. Why not start with his investment in this, in the very start of this video?
Right. Let's discuss about his insurance business. Yes, they've acquired a lot of businesses, but this is the time when they've started a new business in insurance. We know so far that Berkshire Hathaway would reinsure the insurance companies. This is the time when they're entering into reinsuring the reinsurers.
Oh, wow.
Let's take an Indian example. Let's say you have ICICI Lombard or HDFC Ergo as insurance companies in India. If they have taken a lot of risk, what they can do is reinsure that risk with General Insurance Corporation of India. What if General Insurance Corporation of India feels that they have also taken too much risk? They can transfer it to Berkshire Hathaway. They can purchase a reinsurance from Berkshire Hathaway.
Right.
So reinsurance is clearly a more risky business than insurance business. They're getting into an even riskier business. And Warren Buffett and Charlie Munger are following David Ogilvy on his advice where he says, develop your eccentricities when you're young.
But first, let us understand and discuss what eccentricities are.
Eccentricity is like a weird or an unusual behavior. It may not be inappropriate, but it's just an unusual behavior. Maybe if we take Warren Buffett's case only, for being the billionaire he doesn't spend more than $3.17 on breakfast. Of course, this is what we hear here and there. Maybe the other eccentricity of a Warren Buffett could be like he doesn't use a computer or he drinks 5 Cokes in a day. It's not inappropriate. It's just like unusual behavior that we see.
A little odd.
Yeah, so these are eccentricities, and Warren is saying it's better that you develop your eccentricities when you're young, because when you get older and then you start having these eccentricities, people will think that you've gone bonkers, you've gone gaga.
So true.
So reinsuring the reinsurers is a very risky business. They don't want to enter it too late in their lives or too late in Berkshire Hathaway's life when people start thinking that this is a stupid decision trying to amp up their earnings. Now, as a reinsurer, they keep earning premiums and the claims may not come calling for many, many years. So those many years you will see good profits. But there would be one black swan year when you would see tremendous losses. So he's saying your combined ratio could range anywhere between 0 to 300. The reason why they can afford this kind of a swing in their earnings is because they are large in size, they have that kind of capital reserves, and they have these huge float reserves.
Okay, before we go ahead, we need to understand first that what is a combined ratio and what is a float?
I can take the combined ratio. Combined ratio measures the profitability of an insurance company. Let me first tell you the definition. So combined ratio is, there is a numerator, denominator. The numerator has all the operating expenses that an insurance company has, plus all the claims related expenses, whether it could be actual claims or the provisions that they made. And in the denominator, they will have all the premiums that they have received. So combined ratio is equal to the operating expenses plus claims divided by the actual premiums received. So if this percentage is more than 100%, that means the company, the insurance company is having more claim related expenses than the premiums that they are receiving.
Okay.
For most of the Indian companies, it would be in between 100 to 130%. But as Vineet is saying, I'm sure it would be the same case for US companies as well.
So around that time, it was ranging anywhere between 110 to 120 for US companies, specifically for Berkshire Hathaway. Specifically for Berkshire Hathaway's reinsurance business, it was going to range anywhere between 0 to 300.
Yeah. Wow. So that was their risk appetite that they had in reinsurance business.
Yes. Now let me explain float with an example. As Satya explained, you have numerator and denominator. In denominator, you have the revenues. Let's say you earn 100 as premium revenues. You incurred 10 as operating expenses. You paid 20 in claims. Plus, you created a provision of 80 for claims that will come calling in the future. In total, this is 110 divided by 100. So this 110 is your combined ratio. Now, how can they have expenses higher than revenues and still make money? It's because now this 10 and this 20 are actual cash expenses. This 80 is a provision. So this 10 plus 20, 30 is what you spent. The remaining 70 is what goes as float. If you're a small-time investor, you will invest in more safer securities so that you are able to honor the claims that come calling in the subsequent years. But you are Berkshire Hathaway, so you're large in size. You have the flexibility to invest part of your investments in long-term risky securities as well. So out of the returns that they make out of investing float, they pay whatever claims come calling, and the rest is earnings for Berkshire Hathaway.
Okay, so it seems as if float is kind of a free money for them?
It's not exactly free money, it's cheap money. Now, let's say if Warren had to acquire this 70 from the bank, he would have had to acquire it at 7, 8, or maybe 10%. Over here, he's acquired it for free, and he keeps investing this money. Over the many years by selling policies, let's say the float has now gone up to 1,000. And let's say next year, if the claims are called at 20, you're paying only 20 as claims out of 1,000 on your float. Effectively, you have just paid 2% on this float. That is your cheap float. Borrowing would have been much more expensive. In the meanwhile, Berkshire gets to invest this and make money out of this.
Wow, Vineet, this looks like a very interesting business to be in. But what are the other investments that we are going to discuss?
Let's talk about shoe businesses. Around 1990 or 91, he invested in H.H. Brown, and subsequently in the next few years, he also invested in Dexter's Shoe and Lowell Shoe. Now, this seems a little strange because around this time, shoe manufacturing was moving to Asian countries, and he was investing in 3 shoe manufacturing businesses.
Yes, it's more like a textile business. Even he acquired textile business when there was so many problems with that business, and where exactly as you said, a lot of competition was there from the other countries. Does it seem like that? I mean, definitely one of the parameters in Warren Buffett's stock market investing, which is having long-term prospects for a business, is not matching.
Perhaps it certainly looks like that, but let's explore that in the subsequent episodes.
Okay, then you also talked about Gillette and Coca-Cola as your, investments that was made in this period.
Yes, so he picked preferred shares in Gillette and US Air. In fact, for Gillette, he's saying he's using these letters to his shareholders to tell them to use Gillette razors. And Coca-Cola, this business was already around for more than 100 years when Warren invested in it. So Coca-Cola was already a market leader in the US. And around this time, Warren explains that Coca-Cola is looking to now become a global market leader. Interestingly, when he had picked stake in Coca-Cola, he took a special waiver from the SEC to not announce his acquisition for the next 1 year. And in the meanwhile, he accumulated more than 6% in the company and became a director. And after that, he announced, because he knew that he was a very popular investor and wherever he invested, those stocks ran up. So he did not declare it to the public or even his shareholders for the next more than 1 year.
So he was actually saving it for the right price, because if he would have disclosed, then the price would have rampant up and he would not have been able to buy at a nice price.
Right. Here's another small trivia about Coca-Cola and Warren Buffett. We all know that Warren Buffett drinks about 5 Cokes a day, and he also calls that I'm a quarter Coca-Cola, which means to say that he takes about 25% of the calories in a day from the drink. But interesting fact is that he moved to Coke after drinking Pepsi for about 48 to 50 years. So it's his neighbor who became the chief operating officer at Coca-Cola, and then he sent samples to Warren Buffett asking him to try this Coke with cherry flavor. Apparently cherry flavor is the favorite taste of Warren Buffett. And then later it also became, the Coke Cherry has also become the official drink of Berkshire Hathaway annual general meetings.
So apparently that other story that I remember was that Warren Buffett was into having Coke, fries and burger as his appetite, and the justification that he gave was, there was this report which said that a 6-year-old has a better life expectancy, and what would a 6-year-old do? Eat fries, have burgers and Coca-Cola, and that is how he justified his lifestyle and life expectancy that we can clearly see today. So Vineet, while we were discussing the agenda, you said that he took a jab at the auditors and criticizing the auditors, but what was that about?
Sure, he did criticize auditors on a few fronts. For example, let me take this example again. Now, this 80 was provision in our example, where 100 was your revenues, 10 are the operating expenses, 20 are the claims you paid, and 80 are your provisions. This provision is based on assumptions. There's actuarial assumptions, there's some business acumen that goes into it. However, there's no way to guarantee that these assumptions are correct. Your actual losses could be much bigger or smaller than this number. So when an auditor is saying that the numbers presented in these financials of this insurance company are true and accurate, there's no way for the business or the auditor to say that this 80 is accurate. Then why should they say it? So sometimes these auditors or even the businessmen would lack the competency or lack the intent. In fact, lack of competence is one thing, but lack of intent can amount to accounting shenanigans, fraud, manipulation, etc., etc. Now, Warren is saying that if a business is engaging in accounting fraud or manipulation, it is hard to believe that the auditor was not in bed with them. He's saying that over time, it has become easier to steal large sums of money using pen than small sums of money using gun.
Wow.
Wow.
Warren is also talking of an interesting term called big bath. Let's say if there's a company that has been hiding its losses for the past few years, and suddenly this particular quarter, they know that they're going to suffer massive losses. What they do is all the losses that they've been hiding for the past few years, they club them together and load it in this particular quarter. So the losses look much bigger. So if in the next quarter, their losses are smaller, or if they show even a tiny bit of profitability, the market looks at it as revival to the path of profitability.
Oh, this reminds me of the scam that took place in US, the Enron scam, and a very similar scam in India, the Satyam scam.
Yes. Yes, so it is hard to believe that the auditors were not colluding with the businesses to manipulate their accounts.
Sticking to this point on auditors colluding with management, of course, this all happened a few decades ago, and the rules and duties of auditors have changed globally, have evolved globally and also domestically. Maybe to mention a few with respect to India, there is rotation of auditors that has been introduced so that there is lesser influence of auditors on the management or the management on auditors. There is increased standards of transparency, increased standards of disclosures. For example, the auditor's fees has to be disclosed. There is a scope of the work that can be done by the auditor that cannot be done by the auditor. There is whistleblower protection. In fact, there is also some a body called NFRA, National Financial Reporting Agency, which looks after the job of the auditors, monitors the jobs of the auditors and the Indian accounting standards. It's just to say that rules have evolved over the years. It's not to say it doesn't happen now, just that these measures are a right step forward.
Now, Astha, why don't you tell me what junk bonds are?
Okay, so when we are investing in bonds, one thing we look for is the credit rating. So if the bonds have poor credit rating, that is when we see that they are junk bonds. To give you an example, if the credit rating is, for example, say triple B minus according to S&P standards, so that will be considered as a junk bond.
Correct. Now, Warren is saying that he would invest in some junk bonds. Basically, these bonds were investment grade. Let's say they were AAA or AA rated. The company had an external shock and the bonds were downgraded to junk. Warren is investing in these bonds when he knows that the management is in place and is determined to bring the business back to profitability. A lot of other investors are also investing in junk bonds at the same time because they saw that this kind of investment gave them much higher returns despite investing in a fixed income instrument. Now, the problem was that investment bankers saw that there was demand for junk bonds, so they started going to companies that were really downtrodden and started issuing bonds that were originally junk to begin with.
I think what Warren was purchasing were the bonds which were originally investment grade, became junk bond, and which are in a path of becoming a investment grade.
Yes.
But because of the popularity of those bonds and the higher yield that these bonds are offering, newer bonds which are originally junk bonds were being issued. And the newer issues are being compared with those older issues, as we discussed, that Warren has invested in. So this comparison is wrong. As you said, Warren also talked about it again. And he also went to say that these are the bonds that were issued by those who didn't care to those who didn't think.
This also reminds me, of the time when India was under the British control. There was this time when the problem of snakes was there, and the British government said that if you see snakes, bring them to us and we will pay you instead. So what people started doing, since money was involved, they started breeding snakes in their backyard in order to be rewarded by the government.
These bonds were sold saying that this will help in diversifying your entire portfolio, or it will improve the yields on your portfolio, etc., etc. But what Warren was saying is what it is compared against is what you have to understand, and also, as Warren and Charlie always refer to, which is margin of safety. What happens if these bonds really collapse, or what is the risk of default in it? And if there is no value unlocking in these bonds, it is better to sit with cash rather than being invested in these bonds.
So Warren raised the alarm in 1987, and a lot of bonds actually went down to zero value in 1990. Surprisingly, in 1990, Warren expressed another fear, which came true in 2008.
Are you talking about the financial crisis of 2008?
Yes, and specifically with the banking sector. He's saying that around that time, a lot of stress is being built up in the banking sector. They are taking excessive leverage to the tune of 20x their equity. Now let me explain that with an example, how it works. Now let's say a bank has an equity of 100. Nowadays, you will see that the bank will generally lend to the tune of 500 to 600. How do they lend so much when the equity is just 100? There are depositors, let's say savings account and fixed deposits. The money that these customers deposit with the bank is then lent out to the borrowers. At the time, Warren is saying that the leverage had gone up to 20-25x, meaning you have equity of 100 and you are giving out loans that are worth 2,000. The problem here is, what if only 50 out of this goes bad, becomes NPA, that about 50 worths of borrowers do not pay up. When you record profits, it adds to your equity. When there are losses, it hits your equity. And the loss here will translate your equity to just 50. Meaning you have 15 equity and 2,000 in loans that you've given out, meaning 40x leverage. The problem here is that what if these depositors who have kept money with you, they ask for their money back? You have given out all the money to your borrowers. How will you pay up? You just have 50 with you.
Right.
So that is the stress that Warren is talking about in the banking sector.
We are talking about Warren's concerns about investment bankers peddling with junk bonds, and you also are talking about concerns that Warren Buffett had with banking sector. But didn't Warren Buffett himself invested in an investment bank, which is Salomon Brothers?
Yes, for the money. Well, on a serious note, it was on the verge of being acquired in a hostile takeover. And at the time, it was run by John Goodfriend, who was actually a good friend of Warren Buffett from before. Now, Warren was aware of the dicey financial nature of Salomon Brothers, so he demanded that he get at least 15% return from his investment, and that is why they give him preferred stock. Warren invests $700 million at the time in Salomon Brothers, and for that, Warren and Charlie both got a board seat in Salomon Brothers. The problem started unfolding 4 years later for them when a scam was unfolded in the bond trading desk of Salomon. The CEO of Salomon Brothers, John Goodfriend, was aware of the scam but did not tell Warren or any other board members. When the regulators started sniffing around, John resigned, and in a sudden move, Warren was installed as the chairman of Salomon Brothers. He was there for 10 months and Warren hated being there. So eventually, when a few years later Salomon Brothers was sold to Travelers Corporation, Warren made decent 14-15% returns, but he did not like that he and Charlie had to break so much sweat over it.
Yeah, in fact, Warren was also summoned before the members of the Congress about this case. He felt that his reputation was in line. Though he made profits, as you said, it has been one of the most controversial investments for him over the years.
And at that time, he says, lose money for the business and I shall be understanding. Lose a shred of reputation and I shall be ruthless.
That was intense.
Yes. And on a related note about investment bankers, Warren also had a problem with EBITDA, which was a term that was mostly concocted by investment bankers, and also with stock options that the businesses would give out to their CEOs and employees. Let's begin with EBITDA. At the time, it was called EBITDA, earnings before depreciation, interest, and tax, which today we know as EBITDA, earnings before interest, tax, depreciation, and amortization. According to Warren, this is a half stick or a sawed-off yardstick when you're looking at the profitability of a company. Of course, when you're comparing two companies with a different asset base or a different capital structure, EBITDA is a very good way to compare. But when you're looking at the prospects of a single company, EBITDA is an inadequate measure. So when you're looking to acquire a business or when you're looking to sell a business and you're looking at their EBITDA, it's a half measure of their profitability. You cannot ignore the depreciation, interest, and tax that the business is paying. Those are actual costs. Most importantly, how can you ignore depreciation? The assets that the business has are what are supporting the function, the operations of the business. You've already paid for it, so you have to account for those expenses somewhere. How can you say that you cannot account for depreciation and still be profitable?
Right. I have a doubt here, Vineet. Often operating profit and EBITDA are interchangeably used. Do they mean the same thing or is there a difference?
No, not really. EBIT, earnings before interest and taxes, could be called operating profit, but EBITDA cannot be because depreciation is an operating expense. You cannot ignore that. So EBITDA is not operating profit. EBIT can be operating profit.
Yeah, Warren has very strong views about this, not taking depreciation as an expense. He also say this. No, generally, what is depreciation? It's an ongoing capital expenditure for any company that is recorded in the P&L. It is reduced from the value of the asset and it is written in the P&L, expense written off in the P&L. It's a ongoing recurring capital expenditure. Now, Warren is saying this, comparing it with meals for a human. So he's saying that capital outlays can be skipped for a month or so, just like a human can skip a meal for a day or a week. But if this skipping is routine, then the body eventually becomes weak and dies.
So now moving on to the last bit of concepts that Warren thinks were abused, it's stock options. Now there are two problems with stock options as well in the way they were used. First of all, at the time, stock options were not listed as an expense in the P&L. Of course, you have the accounting rules now, you have to expense them in your P&L. At the time, you didn't do that. And the CEOs would argue that it's difficult to value these options, hence we are not putting them as an expense. And anyway, we are not spending any cash on stock options, so let's not assign any value to them. Now, Warren is saying that if there's a CEO who says there should be no value assigned to stock options, I want to buy that CEO's stock options. The price at which the CEO will sell it to me is the value you should be assigning and expensing in the P&L.
Nice.
And the second problem with stock options is that they're dilutive in nature. So it's understood that you give stock options to your employees so that they also feel included as owners in the business, and they are participating in the business's profits. But if you start aggressively compensating all your employees with a lot of options, it becomes dilutive for your older shareholders, where they are left with smaller earnings share.
Can this be explained better with the help of an example?
Yeah, it's a general math. Say suppose a company has earnings of about 1,000, and if the number of shareholders are 100, so what is the EPS? It's 10. And if the number of shareholders go up, say suppose it went up to 200, the same amount of earnings has to be distributed among 200 shareholders now, which would eventually the EPS will come down, right? So having said that, not all ESOPs are bad for the existing shareholders as well. That's because most of the times ESOPs are given to retain the talent in the company. And this is the talent, the employees who are loyal to the company and who might also bring revenues to the company in the long run, which eventually could increase the value of the existing shareholders. Of course, it has to be seen in case to case and what is the intent with that particular issue.
Wow, there is so much to learn from these letters. And Vineet, in the beginning, you said that it's been 25 years of Berkshire Hathaway being in existence. So what are some of the highlights that we have from this 25-year-old business?
Of course, it's been 25 years, and over these years, Berkshire Hathaway has become a behemoth of corporation, and Warren Buffett has also become the second richest American around this time. So people are following Berkshire Hathaway's activities, where they are investing or what stocks they are selling. So there's a lot of speculation, there's a lot of rumors going around Berkshire's activities, and a lot of reputed media houses are also sometimes falling prey to this when they are saying that Berkshire Hathaway is expected to buy XYZ stock. Now Warren is justifying, he's saying whether we are doing it or not, we can neither confirm nor deny. Let's say there's a speculation. If it is true and he says nothing, and if it is false, he expressly denies it, and it becomes a pattern. So every time his silence becomes affirmation and his expressed denial becomes denial. So he wants to avoid commenting on his activities.
A lot of companies also do this, no? I mean, generally, for a lot of media reports or a lot of rumors, they don't actively go out and say whether it is true or not. A lot of companies also do that. In fact, explicitly, Zomato also recently did that for one of the rumors that has been in the news. They tweeted out, I guess, that they can neither confirm nor deny the transaction. When it comes to cloning the portfolio, that's a very, very interesting topic, because you're saying that a lot of investors are also following Warren Buffett's stocks and investments, Berkshire investments, because they want to clone their investments for their portfolio. Cloning the portfolio means replicating the ideas, investing ideas of the famous investors for their own portfolios. Now, in fact, Warren also in one of the books has admitted that in the beginning of his career, he has used a lot of Graham's ideas to make profit. Now, of course, for any of the investors who are starting, this is a nice guide for them, because whatever the stocks these people are talking about, it's already a filtered stock. So yeah, the filtration has been already done. It could be only a idea for them, to see that, okay, fine, this is one of the stocks that is available to invest. But there are also demerits when it comes to cloning the investments. The first is, we don't know what is the price at which that investment was bought. We know that a particular stock was purchased after it has been purchased by the famous investor. We don't know what's the price at which it was invested. The price would have gone up, and there must be no value that could be still available in that particular stock after the hike in the price. The second is, this particular stock was selected by the original investor or the famous investor after doing a lot of research and having a lot of conviction. As investors, normal investors who are replicating others' portfolios, we may not have that kind of conviction to hold to that stock when the stock is falling. That's a second demerit of cloning the portfolio. The third point is the risk appetite. The original investor whose investment portfolio that we are replicating, for that investor, this stock, a purchase could be just a 0%, 0.5% or 1% of his or her entire portfolio. But when we are investing, based on the amount we invest, it could be significant or insignificant. Also, the investment horizon also matters when we are investing. We don't know all these things, and the fourth important point is the exit. We don't know when to exit. We entered based on the portfolio replication, but sometimes we don't know when to exit. Not knowing when to exit is also a problem in stocks, as we all know.
Now moving on, Astha, like you said, we will discuss the 25 years. Warren takes the time in 1990s shareholder letters to explain the mistakes that he made over the past 25 years. First of all, he says the biggest mistake was buying Berkshire, the textiles business.
Okay.
He's saying that he knew from the beginning that it was a difficult business to enter in, and he still entered, hoping to make some short-term profits, because at the time he was following Ben Graham's cigar butt investing.
Okay, what is cigar butt investing?
Now, cigar butt, let's talk about what is cigar butt. So, cigar butt is the last part of the cigarette that you may find on roadside. So, you can pick up that cigar butt, have the last puff, throw it away, which is for free, right? Now, what is the linkage between the cigar butt and cigar butt investing? Why the name cigar butt investing? It's because Warren used to find companies which are much lower to its liquidation value, maybe because of deterioration of the business or for whatever reasons it is, and used to buy those companies and wait for the stock prices to either go up or for the liquidation to get higher price and make profit out of it.
That one last puff.
That one last puff.
And Warren is saying that he does not want to invest in businesses that do not have great prospects, even if they are run by great management. Let's say the manager is really good and competent, someone you would want your daughter to marry with, but if they are not running a good business, a business with good prospects, it's not going to make you money. If you combine a good manager with bad business, it's the reputation of the bad business that will survive. Also, he wants to only associate with competent and honest managers. He's saying if the business is very good, but the manager is not honest, he's generally seen losses in his experience.
Vineet, but he also says that investors should invest in companies that even fools can manage, because someday a fool will.
Yes, so basically those have to be simple businesses that you would understand. Now Warren is saying that he also made errors in such businesses. There were businesses he understood and appreciated and still did not invest in those. So he's regretting that. That is not to say that he regrets not investing in the likes of, let's say, Apple, IBM or Xerox. He does not understand technology, he does not want to invest in those. And lastly, he's saying that Berkshire Hathaway could have done much better in its performance. Mind you, he has given a 23% growth through these 25 years in the book value of Berkshire Hathaway. And he's saying he could have delivered much better returns had he taken some more debt than he took. He's saying they could have taken much higher debt, still within reasonable levels, and had a 99% chance of making more profits and only one chance of failure. He still did not like those odds. He was a man of probabilities, but he did not like those kind of risks and he did not take it.
You see, what that I see here is that he is okay taking risk when he is reinsuring the reinsurer, but whereas in this case, when he can conveniently take a debt and he can pay it off with the lesser amount of risk, he's not comfortable with that. That is Warren Buffett.
He's very aware of what he wants and what he doesn't want, where he can take risk, where he cannot take risk.
Yeah.
Yes.
Vineet, in the previous episode and this episode also, we talked about arbitrage opportunities, that Warren Buffett would often look for arbitrage opportunities, and arbitrage being one of his strategies. What were some other strategies that he was, looking for, or what strategies he allocated his capital to, or what not to?
Well, primarily he was only invested in equity and debt. He would occasionally indulge in arbitrage when they had cash. Beyond that, he was mostly dismissive of all other strategies. Specifically, he's pointing out the problems with technical analysis or momentum strategies.
Let's talk momentum strategy first. In this case, you look at the prices of the stock in the last few trading sessions. If it keeps going up, you go buy that stock. If it keeps falling down, you go sell that stock. That is the momentum strategy. Now, coming to the technical analysis part, momentum is a strategy and technical analysis is a different style of investing, where you look for the patterns or the trends in the past stock price movement and its volumes. Based on that, you will predict what would be the direction of the stock. That is how we can describe the momentum and technical analysis.
So now Warren is saying that these professional money managers were not essentially looking at the business fundamentals, but were looking at what other money managers were doing. And this is why he dismissed, or in fact chuckled at these strategies and did not want to use them in his portfolio.
But I have a question here. Nowadays, we see that fund managers are actually following technical and momentum strategies. So are they wrong in what they are doing, or where am I getting it wrong?
Warren has this core philosophy of value investing and long-term investing. Over years, there are also different kinds of strategies and analysis that have come into picture. It could work, may not work, but if an investor has chosen one particular type of investing strategy or style, they have to understand what are the risks that come along with that strategy.
So Warren's strategy was long-term investing. In fact, he lists out 3 investments around this time that were his forever investments. He's saying Washington Post, Geico, and Cap Cities, which later became Disney, were his forever investments. He was not going to let go of them unless they had to offload all their float and still had claims to honor.
Yeah, he looks at these companies as a permanent part of Berkshire Hathaway, not as a merchandise which he could sell off if Mr. Market offers a sufficiently high price.
Vineet, I believe by now Warren was somewhere around 60, 61. So were his kids also involved in the business? Because, eventually he has to pass on the business to them.
He had a succession plan in place, but his kids were not involved in the business. He did try to involve his younger son, Peter, in the business, but there's no concrete mention of him around this time. He had nominated his wife to inherit his shares in case he passed away. And he would be succeeded by a manager whose philosophy aligned with Warren's philosophy. However, there's no mention of any person who Warren thought could replace him. Although several years later, Charlie Munger mistakenly blurted out the name who was going to succeed them in the business.
Who was it?
Well, that's for the subsequent episodes.
I'm already excited for the upcoming episodes.
Oh, and one last point, Astha. Warren says that his ideal retirement age is 5 years after he dies, and that number is also negotiable.
Warren being Warren here. So we've almost reached to the end of this video. Before we end this video, let's quickly summarize and see what we have learned. Satya, why don't you go first?
Sure. I think the first point is about the accounting shenanigans that the management and apparently auditors were also involved. This really highlights the point that how important for an investor to check whether the corporate governance at the company is good or not. Usually when we start to invest, we look at the valuations, we look at the growth, we look at all the financial aspects of the company, but may not usually give so much importance to the corporate governance. I think these financial scams make it really, really important and emphasizes how important it is to understand the corporate governance and how the management is. So that's the first point. The second is about junk bonds. A lot of financial product sellers even today might tell us, things like diversification, high yield, etc. to sell us financial products that may not suit us. It is up to us to see whether it suits our risk appetite and whether we have enough margin of safety that is in line with our risk appetite. That's the second one. And the third one could be about the reinsurance, how Warren took the risk of entering into a reinsurance business but did not take debt, even though he was able to take the debt very conveniently. As I said, I think he exactly knows what he wants, what he doesn't want, what he can, what he cannot, and what's his risk appetite. I think everyone, all the investors, we all should be aware of what we can and what we cannot.
Then we spoke of EBITDA, where Warren is saying that it's a sort of yardstick when you're looking at a company's profitability. Of course, when you're comparing two companies with different capital bases or asset bases, you could use EBITDA, but not otherwise. Then we spoke of stock options, which were not expensed at the time, but are now expensed rightly so, and that they are used as a way of compensating employees. The problem comes only if you're aggressively diluting existing shareholders' stake through stock options. And we also looked at cigar butt investing, where you're investing in a company that is near liquidation. However, while this strategy might be profitable, if you are a large fund or if you are a big investor, the profits coming out of cigar butt may not move the needle for you much. So you might be better off using Charlie Munger's long-term earnings prospect kind of an investment approach.
And moving on towards the end of the video, we discussed about that how their portfolio was being clowned and the speculations that were playing around. They could not say yes or they could not say no to what they were acquiring or what they were not. And eventually a lot of business managers also are using the strategy these days where they cannot deny or accept to the situations. But apart from speculation, investors need to focus on that. You don't clone the portfolio until and unless you understand what is the purpose and you understand the parameters that Satya rightly quoted as what is the entry point, what is the exit point, what is the risk attached to it. Then further in the video, Warren Buffett talked about that he is dismissing technical and momentum strategies. Well, he is dismissing it because he has a better strategy to play with. If you think that these strategies are profitable for you or they are working well for you, then it is fine. But whatever is working well for you, you should stick to that, and you should just not fiddle with so many strategies in order to make a quick money. And lastly, he talked about a succession plan. So the thing that I liked is that since his kids are not involved in the business, he's not making an effort to do it. He's looking after the person who has a similar interest to it, who understands the business acumen as he does, and at the very right time, at the very right stage, he has come up with a succession plan so that he can ensure that Berkshire Hathaway has a longer life with or without him. So this was all about episode 3, where we had discussed numerous learning lessons for all you investors. Do tell us in the comment box what were your learnings from this episode. See you in the next one. Happy investing.